Between January and September 2025, a massive wave of job cuts swept the American workforce. Data shows over 946,000 positions were eliminated in that 9-month window. That represents a 55% increase over the same period last year. Roughly 300,000 of those cuts came specifically from the government sector, marking the highest level of workforce reduction since 2020. With generative AI dominating the headlines at the same time these cuts are being announced, many observers assume the technology is simply making these human workers redundant. However, integrating AI into a business model to actually replace human labor is proving to be a slow, expensive, and incredibly complex exercise. Current research has found almost no evidence that AI models can handle the nuanced decision-making required for white-collar middle management. For most firms, the technology has yet to result in any significant reduction in headcount. Even at companies leading the AI revolution, the layoffs are often driven by traditional corporate problems. In October 2025, Meta cut 600 employees from its own AI unit, not because a computer replaced them, but because the department had simply become too bloated to move quickly. This creates a glaring contradiction. If the technology isn't actually ready to take these jobs, why are companies firing people by the hundreds of thousands while letting AI take the credit? To understand the real cause of these layoffs, we have to look past the software and examine the way these corporations have grown over the last few years. During periods of easy growth, major firms often develop corporate bloat, adding unnecessary layers of middle management that create a drag on the entire organization. This structure forces employees to spend the majority of their day in meetings talking about work rather than actually doing it. When a single project requires 5 different layers of management approval, actual innovation and progress slows to a complete crawl. Today, those companies are facing a high interest rate environment and a significant drop in consumer spending. As the economy tightens, executives are realizing they can no longer afford to maintain these deep management structures. The current job cuts represent a classic economic reaction to a weakening market. This economic reality has given rise to a corporate strategy known as AI washing, using technology as a mask for traditional downsizing. When a CEO admits they are cutting staff because their business is struggling, Wall Street often responds by selling off the company's stock. But if that same CEO attributes the layoffs to an AI-driven strategy, they often see their stock price jump. Investors are currently eager to reward any company that uses the right buzzwords. This creates an incentive for management to claim they have a grand AI pivot in place, even if their actual use of the technology is limited to something as simple as using a chatbot to help draft an email. The pressure to maintain this narrative is intense. Roughly 79% of U.S. CEOs recently admitted they fear for their own jobs if they fail to deliver measurable business gains through AI within the next 2 years. Labeling routine layoffs as AI innovation has become a necessary survival tactic for executives protecting stock value and their own positions. This rush to appease the market through overcutting carries significant long-term risks that many boards are choosing to ignore. By executing these massive cuts during an economic shift, executives are essentially gambling that they've correctly guessed the severity of the coming downturn. However, recent financial research suggests that the logic behind these mass restructurings is flawed. The data shows that the longer a company can resist a layoff, the better its long-term financial performance tends to be. Many executives fall into a rebound trap. The immediate money saved by reducing headcount is much lower than projected. The real costs appear on the back end. Once the economy recovers, recruiting new talent, training, and workflow disruptions far exceed the initial savings. The next time you see a headline about a massive AI layoff, look past the branding. These cuts often represent a calculated accounting trick by panicked executives trying to satisfy Wall Street at the expense of their company's future.